Welcome to the Freedom Capital Management Strategies Quarterly Market Review and Outlook. I'm Brian Zabor, Investments Director. I'm here with Peter Murphy, Chief Investment Officer. Pete, investors were taken on a roller coaster ride in the first quarter. We saw equity markets down 19% to start the quarter as Liberation Day tariffs were more onerous than expected. Then in just 54 days, markets recovered those losses as those tariffs were walked back. Could you run through the events during the quarter?
Thank you, Brian, and thank you all for joining us. Wow, what a quarter. For investors, I can't remember a quarter with so many significant and meaningful headlines that came across the news wires. From the tariff announcements on Liberation Day to the eventual rollback of many of those tariffs, to news that a third credit rating agency has downgraded the U.S. government debt, to an escalation in the conflict in the Middle East with Israel and also the U.S. attacking Iran. There were so many newsworthy events, many of which brought great uncertainty to the geopolitical situation, but also to financial markets at large. And amazingly, the S&P 500 rose over 10% in the second quarter, and most global stock market indices followed in turn. Further than that, if you look at the first 6 months of the year, while there was a very challenging quarter for the S&P 500, if you stretch out to the whole first half of the year, the S&P was actually up 6%. And when you look at this, and you just look at the headlines and all the negative news that came across the wires, the market continued to grind higher. The S&P ended the quarter at an all-time high, and it was just a textbook case study in the perils of market timing and trying to react to feelings of negativity and risk and concern on a short-term basis that can really cause long-term pain to an investment plan by missing out on some of the tremendous opportunity that can be created amidst turmoil and chaos. So really important lesson for investors in the second quarter around the importance of staying disciplined and avoiding the temptation to time markets.
Pete, those are great perspectives. Could you get under the hood a little bit and talk about some of the individual trends within the quarter?
Absolutely, and so I spoke a lot about the S&P 500 in my opening comments because that's the benchmark that so many investors hear about in the media and is familiar. But as we know, financial markets are global in nature. There are many stocks beyond just the 500 largest companies in the U.S. represented by the S&P, and there was a lot going on in the second quarter if you dig down a little bit below the surface. So the first thing to note is once again, international stock markets pretty meaningfully outperformed their U.S. counterparts. This was the second consecutive quarter that this happened, and this has really been a significant shift because U.S. markets have outperformed their international peers for much of the past 15 years. And we've just seen tremendous strength in international stock markets. A few things that we think is driving this. The first is there's relative stability compared to the U.S. currently in international markets with all the political elements happening in the U.S. and the change around tariff policy and the like. There's just more uncertainty than there's been for some time. So there's just some degree of increased stability. But the other and probably more important point is the U.S. dollar has been weakening pretty meaningfully in the first half of the year. In fact, an index of the U.S. dollar against other major currencies, the DXY, is actually down 11% in the first half of the year. That's a pretty significant depreciation in the dollar. And when that happens, it actually tends to elevate returns overseas. And so that also helped international markets outperform their U.S. peers. So international outperformance was one of the key themes. The second key theme in the second quarter was a sharp reversal from the first quarter. In the first quarter, we talked about value stocks and defensive stocks being strong outperformers. And we talked about the weakest performers and the stocks declining the most in the first quarter being the big technology darlings, commonly referred to as the Magnificent Seven, struggling. Well, in the second quarter, it was a complete reversal. The big, large U.S. technology stocks, the growth-oriented stocks, led markets sharply higher. And then the value and defensive stocks, they really lagged. They were up, but up much less than their growth peers. And then the final part of the markets in the first quarter is the fixed income market. While it rarely gets the same level of headline as the stock market, fixed income markets globally are actually larger than equity markets. And so when we look at fixed income markets, they actually had a pretty calm quarter. Interest rates were relatively range bound, and that's the biggest driver of bond prices. And yields are relatively high compared to recent years. So bonds had a decent quarter. They were up again. They've been a source of stability this year amid the turmoil, so they've definitely served that safe haven status. However, they significantly underperformed the strong gains in stock markets in the second quarter.
Pete, with all the geopolitical cross currents, how are equity markets globally at all-time highs? What are the key drivers? How is this occurring?
It's a great question, Brian. And as I spoke about earlier, when you think about all the headlines, it's hard to believe that many stock market indices around the world are at record high levels. And what's important for investors to know is the stock market is much more of a long-term pricing mechanism than a short-term day-to-day trading mechanism. And because of that, it's important to focus on the fundamentals that are happening underneath the surface that don't always get the airtime within the financial media. So for example, how do we see continued strength in stock markets amidst so much uncertainty around the global economy and geopolitics? One of the keys is this theme of resilience. We've spoken about this for much of the last couple of years, but there have been so many calls for the US economy to enter recession in recent years, and it just hasn't happened. And the US economy has been much more resilient than most have expected, and it continues to be. When we look at economic growth as measured by GDP, it actually declined modestly in the first quarter, but that was largely driven by a big tariff-induced increase in imports, which actually reduces GDP. And when we look at consumer spending, which represents about 70% of economic activity in the US, that's remained robust and resilient, and it continues to chug along. If we turn our attention to businesses, there's been a lot of concern around the impact of tariffs on businesses and how are they going to adapt? Is it going to reduce profit margins? Is it going to lead to inflation? How are they going to pass the price increases on? And what we've seen is remarkable resilience and businesses that have proven very nimble in their ability to protect margins, to move around supply chains, and despite the uncertainty from tariffs, to continue growing the bottom line. So earnings have been a source of strength and resilience as well. The second notable point is that inflation, while it's no longer front and center in terms of the most important economic data point out there, the trend has been a steady deceleration in inflation that is quickly approaching central bank targets around the world, which is about 2%. And many global central banks, especially the European central banks, are already cutting interest rates. The Federal Reserve started last year and has been on pause because of some of the tariff uncertainty, but they're likely to continue cutting interest rates later this year. And what all that adds up to is a loosening of financial conditions, which tends to be very supportive of asset prices. And we've seen that taking place in the second quarter, these moderating inflation, easing financial conditions as central banks reduce interest rates. The final point that I would note is that early in the second quarter, when there was a sharp crash in stock markets that Brian mentioned earlier, all of the investor attention was focused on tariffs. Liberation Day, the rollback of the tariffs announced on Liberation Day, that dominated the investor psyche. Well, as the quarter progressed, there became less and less concern about tariffs because there seemed to be a steady rollback and a push to negotiate by President Trump. But what we saw is this shift to a focus on the spending and tax cuts in the bill that's currently working its way through Congress. And the shift from tariffs, which was a source of tremendous uncertainty, to a focus on tax cuts and increased government spending, which would both likely support economic growth in the near term, also was a positive shift that took place over the quarter and helped drive markets higher.
Pete, thank you for those insights. With all the geopolitical cross currents, the markets at all-time highs, are there risks you're monitoring?
Absolutely. There's always risks that are confronting investors, and risk management is an important part of any investment management program. And as we look at the current environment, we believe there's three primary risks that investors should be focused on as we enter the second half of 2025. The first is, not surprising, tariffs. While the tariff risk has definitely de-escalated from where it was about 90 days ago, we don't believe we're out of the woods yet because there's still deadlines that are ahead of us, and President Trump has the ability to dramatically impact tariff policy on a whim. We saw that last quarter, how sharply he could shift and turn on a dime and how quickly markets react to that. So the direction of tariffs remains something that's important and consequential to the economy and financial markets. It's one that's very hard to predict, but it's a risk that is real and present and something we're going to be monitoring closely. The second risk factor is a longer term risk factor that has come more into focus in recent months. And that's around US fiscal deficits, debt, and the potential impact on interest rates. As most of you likely know, we've been on a steady trajectory across many administrations at this point of rising fiscal deficits and rising government debt levels. And we've reached levels that are more traditionally associated with wartime, and we're in a very different economic situation today than we are in periods like World War II. And with that, there's questions that continue to bubble up around the sustainability of US fiscal deficits, the sustainability of the amount of debt that we have, and the potential impact on the economy and ultimately interest rates. And while this is something that has been on investors' radar for a long time, the big question is, when will we hit that tipping point where the markets say this is too much, which leads to a repricing of interest rates higher, which would dramatically destabilize the US Treasury market, which is one of the most important markets within the broader financial markets, and leads to greater challenge within the US economy and because of that, the global economy. We don't believe it's necessarily an imminent risk, but it's a risk that is becoming increasingly prevalent, and it continues to grow in terms of the potential of that risk to materialize. And then the final factor is around the Federal Reserve. We said in the first half of the year, the Federal Reserve kind of stepped away from the spotlight for a period of time because there was so much talk around tariffs, there were geopolitical conflicts that were taking center stage. But the Federal Reserve, we expect to come back into focus in the second half of this year. We've seen it recently with President Trump pretty overtly asking Chairman Powell to lower interest rates and pressuring him to do so. That's something we traditionally do not see because of the independence that the Federal Reserve has had in place since its inception. It was 100 years ago. And so that's a potential source of uncertainty. Does that independence become called into question? Does it impact the trajectory of policy going forward? Right now, the market expects the Fed to reduce interest rates starting later this fall. But to what degree and how sustained is that? There's a big question marks for investors. And on top of that, Fed Chair Powell's term ends next year. So we'll have a new Fed chair that President Trump will appoint. And what will that chair's policies be? And how does that potentially change market expectations? So another source of potential risk and uncertainty in the second half of this year.
Pete, those are great insights. What should investors do in the current climate?
Yeah, so for investors, as you know, the future is unpredictable and we can't know what's going to happen. We're just making informed decisions around what we think is most likely to happen. And as always, the things that you can do is to stay disciplined. Avoid the temptation to time markets. I spoke about this at the outset of the video today around the lessons from the second quarter about the perils of trying to time markets. But stay disciplined, focus on your long-term financial plan. Don't get overly caught up in the short-term emotions that can really disrupt your long-term plan by being overly reactive to what's happening in the moment. As we saw in the second quarter, things can change quickly and on a dime, and if we allow ourselves to get too caught up in the moment and emotions to override, it can really prove long-term destructive to the compounding potential and growth potential of the long-term plan and investment portfolio that's been put in place. And then lastly, it's important to stay engaged with your financial advisor, so as your situation evolves, you have an active and engaged relationship and conversation around that with your advisor, and help to make your plan a living plan.
Pete, thank you very much. Thank you for joining us today. We hope you have a wonderful summer, and we look forward to updating you on financial and economic markets in the fall.
Thank you.